One of the most difficult things about dividend investing is knowing the right companies to invest in, and if you're new to all of this and don't know where to start, trying to pick stocks can make you feel like you're just blindly throwing darts at a board, crossing your fingers for a bullseye. Which is why in this video I'm sharing with you my simple 3-step formula for researching stocks, and this is going to help you develop an understanding of some of the essential things you should be looking out for, as well as what you should avoid. But before we get to that, in case you're new to the channel, my name is Ryan, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Anyway, as it pertains to researching individual stocks, the very first thing you need to do, and the best place to start once you've identified a stock that seems interesting, is to determine if you even understand the business. You need to ask yourself and be honest about whether you understand the company's business model and how it makes money. If you do, then fantastic. This is a very big and very important box that you can now check off. This business would be within what Warren Buffett calls your circle of competence, and I'll let him explain real quick what that is and why it's so important.
Defining your circle of competence is the most important aspect of investing. It's not how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson Sr., who started IBM, said in his book, he said, "I'm no genius," he said, "but I'm smart in spots, and I stay around those spots." And you know, that is the key. So if I understand a few things, and I stick in that arena, I'll do okay. And if I don't understand something, but I get all excited about it because my neighbors are talking about it and the stocks are going up and everything, I start fooling around someplace else, eventually I'll get creamed, and I should.
Anyway, in a nutshell, you'll have a lot more confidence investing in things that you can actually wrap your head around, which as a dividend investor hopefully means that you'll be more likely to make winning investment choices and will be able to better predict which companies have the ability to pay steady and growing dividends over time. Now, obviously nothing's guaranteed and none of us can predict the future, but sticking to what you know is going to be a much more sustainable way to invest over the long run versus investing in something that just seems exciting and seems like the next big thing, but is actually like reading a textbook in French or something. Speaking personally, it's because of this idea of staying within your circle of competence that I feel comfortable having companies like Procter & Gamble or Starbucks as the biggest holdings in my portfolio. There have been periods with both of these companies where I've been down by no small percentage, but even during those times, I've been comfortable holding on to them because I understand them well enough to feel confident that the long-term prospects of these businesses are still intact. And that's another thing. It's easy to fixate on what a stock share price is doing right now or what it's done over the last year, but you shouldn't base your entire thesis on a 1-year period. Instead, if you can be confident that the business you're looking at today will look better 5 years down the road or 10 years down the road, then it may be something worth investing in, but you can't develop that confidence if you don't first understand what you're looking at. By the way, this was something that I had to learn the hard way. When I first started investing, I was putting money into companies I had no business being in, like CRISPR Therapeutics or Virgin Galactic. I was just going for things that were way over my head. I started investing pretty much from scratch, and everything I've learned so far up to this point I've had to learn on my own as I've gone along. With that said, considering how deep I've gotten into this stuff over these last few years, pursuing it for my formal education when I was going to college back in the day would have been a really good thing for me, and it definitely would have come in handy, especially as a brand new investor. And with that in mind, I want to talk to you about today's video sponsor, Southern New Hampshire University. As someone who actually didn't finish college and most certainly wasn't after a degree in finance when I was going, there are times where I don't feel the most qualified to talk about some of the topics we cover here on this channel. Because of that, I'd be lying if I said that I've never thought about going back and finishing my degree. And if you feel the same, if you feel like your experience is holding you back from pursuing the career that you really want, then I am so excited to tell you about today's sponsor, Southern New Hampshire University. SNHU has one of the largest accredited nonprofit online degree offerings in the country, and I want to talk to you specifically about their finance program. In this program, you'll learn to identify long-term corporate investment opportunities to increase shareholder value, apply theories of asset allocation, security analysis, and portfolio diversification to efficiently manage an investment portfolio, utilize the rules and regulations for financial accounting and reporting in a global economy, generate financial records and financial statements for users in accordance with governing rules and regulations, and analyze, interpret, and communicate financial and accounting information to internal and external stakeholders. SNHU is radically affordable, with their tuition rates being some of the lowest in the nation. Also, when you go to request information information about one of their 200 plus different programs, a real person will hop on the call and discuss how the program can benefit you personally. To learn more, go to snhu.edu/Ryne or find the link in the description to find out what the current average annual salary is for someone with a finance degree and to request more free information about the program. It only takes one click to find your calling, so once again, go to snhu.edu/Ryne. Anyway guys, getting back to it, if you found a business that you understand, the next thing you'll want to identify is whether or not the business is growing, and you'll do this by looking at the company's financial statements. Reading financial statements is an essential skill that you will need to learn if you're going to be researching individual stocks. And just as an extremely brief overview, there are 3 different financial statements. You've got the income statement that details a company's income and expenses over a specific period. This can tell you if the company has made a profit or incurred a loss during whatever period you're looking at. Next, you've got the balance sheet. This provides a snapshot of all the company's assets and liabilities, as well as the book value that serves as a difference between the two. And then finally, you've got the statement of cash flows, which tracks how cash moves in and out of the business. This can help you assess a company's cash management and is especially important for us dividend investors because it can help you gauge whether or not the dividend is sustainable and can continue to grow since a dividend is paid out of a company's leftover free cash flow. Anyway, to determine whether or not a business is growing and has attractive long-term prospects, you'll definitely want to monitor the free cash flow, but you'll also want to take a look at the company's revenue and earnings, and ideally, you'll want to see both of those trending in a positive direction over time. You can find these on the income statement, and I'm looking at a company called Snap-on's income statement over here on seekingalpha.com. Starting here with the revenue, if we pull up this chart here, we can see that for the most part, Snap-on has been increasing their sales every single year over the last 10 years, and there's a couple of years here, like between 2018 and 2021, it looks like where the sales were down, but otherwise, in general, it's been pretty positive for Snap-on. Furthermore, you can scroll down to the very bottom here, and it'll give us the earnings per share right here, this EPS. So we can see if we pull up this chart, this is more or less the same. We're seeing a very positive direction over time with a couple of down years, but for the most part, Snap-on has been growing on both the top and bottom line. So there is growth here. In general, strong earnings growth over time tends to result in a stock share price moving up over time. So this is definitely an important thing you want to look for, but also a company won't be able to sustainably grow its dividend if its earnings aren't growing. So it's important in that respect as well. Learning how to read financial statements is one of those things that I've had to teach myself over these last few years. And like I said earlier, if you're going to be researching individual companies, it's one of those things that you're just going to have to bite the bullet and learn. I can say one of the most valuable resources for me that's really helped me learn about this stuff is this book right here. And I'm not sure if it'll focus, but this is Warren Buffett and the Interpretation of Financial Statements. I highly recommend you guys pick up a copy of this book. I'll leave it in the description of the video. Essentially, this book will take you item by item through all 3 of the financial statements, and it'll break down what each thing means, how you should be looking at it, and also how it all relates to each other. Like I said, it's been just a really invaluable resource. I can't recommend it enough. And once again, I'll link to it in the description of the video. Anyway, once you found a growing business that you understand, the third thing that you'll want to analyze is whether or not the dividend is sustainable. Now, we've already discussed how revenue, earnings, and free cash flow can play a role in that, but if you want a quick hand way to measure the safety of a company's dividend, you can refer to what's called the payout ratio. This is the percentage of the company's earnings that it decides to pay out as dividends, and the lower you see a payout ratio, the less financially stressful the dividend is for that company, which should mean that it'll have an easier time sustaining those payments and also ideally growing that dividend as time goes on. A great example of this is Snap-on, which is that company we looked at earlier. As you can see, with a payout ratio of only 35%, it's keeping the great majority of its earnings to reinvest back into the business or save for a rainy day. On the other hand, looking at another company like Leggett & Platt here, this one's actually paying out more in dividends than it's earning, and we can tell because the payout ratio is over 100%, which, as I'm sure you can imagine, is definitely not sustainable yet. On the surface, to the untrained eye, this company might certainly look attractive with its juicy 7.8% dividend yield, but if the company continues to pay out more in dividends than it's actually earning, then it won't be able to afford that dividend at that level over the long run, in which case what you're looking at is actually a certified yield trap. A yield trap will lure you in with its ridiculously high dividend yield, but it's only going to disappoint you because that high yield was never sustainable. And in this next video right over here, I'm telling you about 5 stocks that are along these lines that you should avoid at all costs. All 5 of these, in my opinion, look like yield traps, and you'd be doing yourself a big favor if you just completely avoided them. So click right over here to check out which stocks I'm talking about, and I'll see you in the next one.